Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone, to another edition of All Things Financial. What we're discussing in this series is the consequence of if you or a loved one might need advanced medical care or long-term nursing home care or that type of care, but being treated at home, which is called home health care, and how the expenses of that type of care might be devastating or what impact it might have on your family finances. But now it's beyond finances when you get into a situation that someone, either you or a spouse or a loved one, needs that type of care. The burden it puts on other family members that I wanted to go through with you in this whole series. And that's why I'm spending so much time and being so thorough on it, because it's affecting so many families that I deal with, and such a high percentage of families that it's becoming an ever important issue to discuss in retirement planning. I have many families I'm talking to that even as I bring it up to them on the street, not discussing it in office appointments, just casual conversation, is it coming up where they're saying, yeah, I just came from my mom's house, or I just came from my father's house, or my in-laws. We're taking care of them, and we're getting meals for them, and laying out their prescriptions in the morning, or cooking them breakfast, or we have to watch them round the clock. Whatever they're telling me, it just seems to be more and more and more. So I wanted to do this series for those of us who want to plan in advance for if anything happens to us in the future or our parents in the future. How can we best prepare to mitigate the extent those situations might have on ours and our family's finances and lives? So I wanted to start this segment off with a riddle. If you have coverage now for long-term care insurance, or you're looking to buy coverage for long-term care insurance, would you rather have coverage that's 3 miles wide and 1 mile deep, or 1 mile wide and 3 miles deep? Let me express that in a number fashion. When we buy long-term care insurance, and this whole show today is going to continue our discussion on what to look for when you're shopping for long-term care insurance. So let me give you an example. If you're buying a policy and you get to choose the limit, and the limit you choose is $100 a day benefit, that's a $3,000 maximum per month benefit, right? Because there are 30 days in a month. So if you have $100 a day maximum benefit, 30 days in a month, that's a $3,000 a month maximum benefit, right? And that's $36,000 for the year if you buy a 3-year policy, $100 a day maximum, $3,000 a month. You're buying a pot of money, so to speak, that you can use up no faster than $100 a day. And that pot of money, if you add $36,000 and multiply that by 3 years, you have $108,000 in that whole pot of money that cannot be used any faster or more rapidly than $100 a day. So you're buying a pot of money of $108,000, let's say. Now back to my riddle. Are you better off buying $100 a day benefit over 3 years term, in case you stay in a nursing home longer, 2 or 3 years, or buying $300 a day benefit over a 1-year maximum term. Now think about this. You're buying the same amount of money in this pot of money, hypothetically. $300 a day times 30 days is $9,000 a month. If you're buying that benefit 3 times the benefit I just alluded to before, but it's only for 1 year instead of 3, so it's only for 1/3 as long, but it's 3 times the benefit, it ends up being the same amount of dollars. So you might ask, what's the difference? So I want you to think about this. Here's the difference. One of the differences. What if a person goes into a nursing home? And there's no right or wrong answer here, folks. But what if a person goes into a nursing home and only lasts 6 or 9 months? But the cost of their care was $230 a month. The first person, in the example I used, may have only purchased $100 a day maximum benefit. So they bought the $108,000 they needed, but they limited it to they can only pull or access $100 of it per day. If the person in the nursing home lived only 6 or 9 months and then died, didn't they leave a lot of money on the table, uncollected? And didn't it also cause the family, if the cost of care was $230 a day, and they bought a policy with a maximum they could only use $100 each day toward it, weren't they coming up with the other $130 a day out of their pocket? So they had the policy pay $100 a day. The family's coming up with an additional $130 a day out of their pocket. 6 or 9 months later, the person dies. All the rest of the benefit might have died with them. And here the family's out, not only the premiums for the long-term care policy, but also the extra $130 a day because they maxed their daily maximum was too low to cover the actual expense, even though they had the size of the pot of money to cover it. Let's take the second person. They might have chosen only 1 year benefit. And you'll say, wait a minute, what if I'm in a nursing home longer than 1 year? When the second person would say, yeah, but I have a less likelihood of leaving money on the table because if I don't last long in a nursing home, I'm getting my money out faster, up to $300 a day maximum, but it ends in 1 year. So they're collecting their $108,000 hypothetically out of the policy faster, but it's still all, once it's out, it's all gone. So we look at this and it begs this question. Which is better if you had a policy that was 3 miles wide, which means like a benefit for 3 years, but 1 mile deep, which was like a benefit of only $100 a day, but it lasts longer, or 1 mile deep, which means like 1 mile long or wide, which means like a 1 year policy, but 3 miles deep, 3 times as deep, which means or equates to $300 a day. Here's what I ask, and I think you should too. Well, I don't know what's better. What if my care was only $230 a day like I used in the example, and I had up to $300 a daily maximum, but I only had a 1 year benefit? Is the amount that might be unused in any day lost, gone? Or is it reserved in the bank in case after a year I didn't use up the whole $300 a day? Is the residual remaining amount from each day's leftover amount still available after a year for me to use. Many of you need to ask your insurance companies this. What if I don't use the maximum daily benefit? Did I lose that money by choosing a maximum daily that's too high? Or is it still in the bank, so to speak, that after I'm done with my 3-year term or 1-year term, if I didn't use up the daily maximums, there's still money in there to claim until the pot of money would have been used up. So even if I had a 1-year maximum policy at $300 a daily maximum, if I'm claiming only $230 a day, might I have a policy that extends out a couple months after that 1 year expired because there's still money left over? Isn't that important? If it is, maybe you'd rather not take that risk, that you have a longer term policy but a shorter amount daily maximum, because then when you pass away, the tail years, the trailing years after you died, that money stays with the insurance company. So that's a way to consider, should you purchase policies that really have accelerated benefits. If you need to go into a nursing home, or you need to trigger the coverage for care at home, that you're then getting the more money out faster, in case you're not needing it for a long period of time, that you're getting it out faster. Very important. And that brings me to the discussion of indemnity versus reimbursement policies. Because there are very few indemnity policies anymore, but here's the difference. Here's what that means. A reimbursement policy is basically a policy that says if you cannot fulfill 2 out of the 5 or 2 out of the 6 activities of daily living that are normal for people. Those definitions you probably know by now if you listen to my other show, but just in summary, if you cannot bathe yourself, dress yourself, feed yourself, take your medications properly, transfer and switches in and out of, getting in and out of bed safely, things like that. If you cannot do 2 of those 6 or 2 of those 5, depending on the policy, activities of daily living, most policies have you that you are deemed to qualify for coverage. So if you have a reimbursement policy, because you've triggered the coverage definition, that means they'll turn the water faucet on or the money faucet to access your coverages, reimbursing you for any expenses now that you're incurring. But the indemnity policy says differently. The indemnity policy says once you are deemed to not be able to fulfill at least 2 out of the 5 activities of daily living, or 2 out of 6, depending on the policy, they immediately pay you the maximum daily benefit. While you're, throughout the whole period, you can not fulfill those duties. So that means I have a $300 daily max, and immediately if I cannot fulfill 2 days out of 5 or 6, or 2 out of the 5 or 6 activities of daily living, instantly they're starting to write checks, $300 every day, whether I have expenses or am incurring expenses or even getting care or not. They're writing me checks. Where the other reimbursement policy is only reimbursing for any actual expenses I have. See the difference? If I have an indemnity policy, which means they start writing me checks, obviously that's the fastest way to get benefits from that policy once you have the triggering event. But hardly any companies do it anymore. So when you're shopping for policies, I need you to look at what's the total pot of money that you're buying. And then I need you to look at, hey, how much is the premium? For $100 a day maximum for 3 years versus $300 a day maximum for 1 year. Same amount of money. Shouldn't the premiums for both those policies be the same? Because you're buying the exact same maximum amount of coverage. Well, no, they're not going to be the same, because you have a much higher likelihood of exhausting all the coverages, 100% getting access to all the coverages on the short 1-year policy, don't you? Because you don't have to live 3 years to get it all out like you do on the 3-year policy. So the premium rates are likely to be higher on the shorter term policy with a higher maximum benefit. But these are the thought processes I want you to have when you're shopping for insurance. Many people say to me, long-term care insurance is too expensive. And I have to respond with, then no one's taught you how to design policy features. Because you can design policy features at any price point within reason that fits your budget. So you could say, I can only afford $50 a month for policies. You can design a policy for that. It may be skeleton coverages that won't cover much, but it's more than the no policy you'll get because you think they're all too expensive. So you end up with nothing. You see what I mean? So what you want to do is you want to evaluate this further and figure out in your own case, is some coverage better than no coverage at all? Even though everyone tells us what a fool we are to only have bought this low limit of coverage, isn't that possibly, you'd have to ask yourself, better than the none you would have bought otherwise because everybody told you it was too expensive? So use your heads here when you're thinking about this. If you're sitting worrying about the issue, if any one of you or your loved ones needs nursing home care at home or nursing home care in a nursing home that we'd like to protect or prepare for that, then you'll want to evaluate what's the least expense we can at least get something, and then build in coverages beyond that. You'll say, well, I want to cover 3 years. I want to cover $100 a day or $200 a day, whatever it is. Say, this is what I'm more comfortable with. What are the rates? And then when the rates come back with the type of policy you would have liked to design, come back too high, then you pull those back and you say, okay, maybe I'll have to go with just $100 a day or $50 a day for 1 year. See what I mean? There are some companies, and I'll get to this in future programs, but when we shop for insurance, you look at different companies. That's what we need to do. We need to look at different companies. And every company has features different than every other company. But there are a lot of similarities. So that's what I wanted you to look for first. But I wanted you to solve that riddle, because is a policy better 3 miles wide and 1 mile deep, or 1 mile wide and 3 miles deep? Now you know what I mean. 3 miles wide means 3 years of benefit. The depth means how much per day you can get out of that thing, how deep that coverage is per day. So think of it that way, and it might change or add a little factor on how you evaluate your own need. So if you're spending money for long-term care insurance, you're not leaving money on the table if you don't live long enough in the nursing home. Hopefully you never have to go into a nursing home. All right. Now, let's get back to some of these issues on what to shop for in nursing home coverage. When I'm looking at this whole issue, most people, I still go back to what I referred to in the older shows that I started this series with. I want you to evaluate nursing home insurance policies as anti-nursing home policies. I want you to look at these policies and why to buy a policy and whether to buy a policy with home health care protection and coverage intact. And what I mean is, I want you to include it, because if you have home health care coverage and it's an either or, you can use the benefit in a nursing home or at home, whichever the case may be. You'll find some policies will say you have home health care, and now because you have that, you might find the limit is adequate enough that you and your family without being a burden on anyone, because there's coverage available to pay skilled caregivers too to help out. You may have actually designed an anti-nursing home policy plan for yourself, where without it, there wouldn't have been enough money to provide the type of care that can help your family members keep you at home, forcing you no other alternative but to have to go into a nursing home. Because remember, as a rule, it's the cost in a nursing home for the same type of care is a lower cost than that same type of care at home on an individual one-on-one basis, where you have to hire an individual caregiver to provide that service to you one-on-one. In a group environment in a nursing home, it's cheaper. Well, if you've bought nursing home insurance with home health care, and it's enough coverage that you might adequately provide and be able to pay for the costs for the care at home, don't you think that might keep you the ability to not have to go into a nursing home? Or at least extend the amount of time before you would have to go into a nursing home? And in fact, might that not then be the best anti-nursing home insurance policy you could ever design? Well, that's my point in looking at long-term care insurance, shopping for long-term care insurance, getting over the objection that you have in your mind on, I don't want to buy long-term care insurance, I never want to go into a nursing home, to change that phrase to, I never want to go into a nursing home, I'm going to buy long-term care insurance with the design priority on providing enough funds to be able to take care of me at home, keeping me at home, not having to go into a nursing home, or at least reducing the odds of your having to go into a nursing home due to financial reasons, because you've provided for the care being paid for to keep you at home. And isn't that what we all want? If something happens to us, to be able to be cared for at home and not have to go into a nursing home? So look at these nursing home insurance policies in a different light, being designed as your anti-nursing home RX, which is your medication or your prescription to not have to go into a nursing home, possibly, by designing these correctly. All right, folks, we're out of time today. I'll be back again next week with more on this much belabored and difficult issue of long-term healthcare planning in retirement, but how to solve it.
You've been listening to All Things Financial with your friend with the answers to all financial matters, Jack Driscoll of Driscoll Insurance and Financial Services. Securities and investment advisory services offered through Sage Point Financial Incorporated, a registered broker-dealer and registered investment advisor and member FINRA and SIPC. Driscoll Insurance and Financial Services is not affiliated with Sage Point Financial, Inc. or registered as a broker, dealer, or investment advisor. You can reach Driscoll Insurance and Financial Services Incorporated at 412-833-1500, and they are located at 2738 South Park Road, Bethel Park, Pennsylvania, 15102.